Watching Friday's U.S. market action really drove home how complicated things have gotten. The Nasdaq posted its worst week since April, yet the S&P 500 and Dow managed small gains. But this isn't just about tech weakness. The 40-day government shutdown has left markets completely directionless because critical economic data simply isn't being released. September employment reports, October CPI, retail sales, all the indicators markets need to establish direction remain unpublished. Mark Malek, CIO at Siebert Financial, captured it perfectly when he said, "Markets may lack momentum during this data vacuum." What's interesting is how this complex situation is actually showing us the path to resolution. Friday afternoon brought news of 2,100 flight cancellations due to reduced air traffic controller staffing from the shutdown. The Transportation Secretary warned that flight operations could be reduced by up to 20% if the shutdown continues. With Thanksgiving approaching, this triggered a sharp reversal in public opinion. The bigger issue is SNAP, the food assistance program for low-income families. It was suspended in November due to budget shortfalls. A lower court ordered the government to redirect funds from other programs to maintain SNAP, but the Supreme Court blocked this ruling, arguing that budget reallocation isn't within judicial authority. Statistics showing that 58% of SNAP recipients are Democratic voters, and 68% of canceled flights were at airports in Democratic-leaning areas suddenly put Democrats on the defensive. Democrats had been using the filibuster 14 times, refusing to vote on any continuing resolution without a one-year extension of ACA Obamacare subsidies. But now even Democratic governors are urging senators to end the shutdown. 12 moderate Democratic senators are threatening to vote for a continuing resolution if no deal is reached by the 10th. With Republicans holding 53 Senate seats, just 7 Democratic votes would break the filibuster. The compromise being discussed includes 1 extending the continuing resolution through January, 2. Passing 3 of the 12 annual appropriation bills that both parties support, military construction, VA, and agriculture FDA budgets, 3. Including language to prevent mass federal employee layoffs, and 4. Scheduling a vote on ACA subsidy extension in December. If the CR extends to January, ACA subsidies expire at year-end, significantly weakening Democrats' negotiating position. According to Axios, at least 10 Democratic senators are expected to support this procedural vote, putting shutdown resolution probability above 85% this week. Once the shutdown ends, the already completed September jobs report will be released immediately, and October CPI essential for tips. Interest calculations should come out within a week, even if incomplete. But when you look closely at market dynamics, fascinating patterns emerge. Friday saw the Nasdaq drop 0.2%, down 3% for the week, yet Expedia surged 17.6% on the same day. Both revenue and EPS beat estimates for Q3. Total bookings rose 12% year-over-year, revenue up 9%, with particularly strong acceleration in U.S. market demand. High-margin advertising revenue jumped 16%. Airbnb's gross booking value also exceeded expectations with 14% year-over-year growth. They credited introducing RNPL Reserve Now, Pay Later options in the U.S. market with extending booking lead times. Their Q4 holiday season revenue guidance came in above market expectations too. But doesn't this seem contradictory? The November University of Michigan Consumer Sentiment Index fell below expectations, with the Current Conditions Index hitting historic lows. The report reflected concerns about employment instability, fiscal pressures, and prolonged shutdown fears. Michigan's report noted this sentiment decline was widespread across age groups and political affiliations. The key to understanding this contradiction is consumer polarization. Looking closely at Michigan's data, the top third of consumers by stock holdings actually saw improved sentiment due to wealth effects from rising markets. With the S&P 500 up over 20% year-to-date, asset values have grown substantially for these households. Meanwhile, lower-income household conditions continue deteriorating. The snap suspension exemplifies this. This same polarization appears in Q4 corporate earnings forecasts. As analysts adjust Q4 EPS consensus based on October earnings releases, the S&P 500 overall isn't being revised downward as typically happens. Growth sectors like hardware equipment and software services continue seeing upward forecast revisions. Meanwhile, consumer-sensitive sectors like auto components, food, beverage, tobacco, and durable goods apparel face continued downward revisions. NVIDIA CEO Jensen Huang's statement that he's requesting expanded chip supply from TSMC amid surging AI demand confirms the AI investment cycle remains robust. Meta's confirmation of over $600 billion in AI infrastructure investment in the U.S. reinforces this trend. Freedom Holdings' announcement of a $20 billion NVIDIA-based national AI hub in Kazakhstan shows AI investment expanding from semiconductor hardware to data center infrastructure. OpenAI has requested expanding CHIPS Act tax credits to data centers and streamlining permitting processes. These moves confirm AI-related growth drivers remain valid long-term. Jack Ablin, CIO at Crescent Capital, correctly noted that valuations are so elevated that markets react sensitively to even small negatives. Craig Johnson, chief market technician at Piper Sandler, also warned of potential correction phase for mega-cap tech. The Nasdaq's worst week since April validates these concerns. But what's crucial is that growth stock earnings forecasts continue being revised upward, meaning multiple compression is accelerating even as prices correct. With stock prices adjusting while earnings expectations improve, valuations are actually improving. Anthony Saglin, chief market strategist at Ameriprise, expecting increased tech volatility ahead of NVIDIA earnings, can be read as short-term volatility masking a healthy longer-term signal. Mark Hackett, chief market strategist at Nationwide, said, expect consolidation for 2 weeks post-earnings season, then upside resumption. This is key. November has historically been a strong month, and the massive OBBBA tax cut package is expected to positively impact markets long-term. Interest in whether last week's sharp Nasdaq decline will reverse is understandable. To summarize, markets are currently shaking due to short-term uncertainty from the data blackout. But direction should recover this week once the shutdown ends and economic indicators resume publication. Considering the consumer polarization structure, focusing on travel luxury premium services targeting upper income households and AI-related growth stocks makes sense for Q4 strategy. Consumer discretionary targeting lower income segments requires caution. This week brings Veterans Day on the 11th, bond market closed, October CPI on the 13th, and PPI plus retail sales on the 14th. Major corporate earnings from Cisco Systems, Transmedics Group, Applied Materials, and Walt Disney are scheduled. Multiple Fed official speeches are planned, so volatility will continue. Ultimately, we're at peak complexity right now, but the process of unwinding that complexity itself could signal the rebound. Whether to view short-term corrections as opportunities or remain cautious about further declines depends on this week's shutdown resolution and subsequent economic data releases.